Hello traders, Gary Wagner here. Approximately 10:45 in Honolulu, 3:45 in New York, Wednesday, February the 3rd, 2016, and we are looking at the final 15 minutes of trading in the U.S. equities markets. Dow Jones Industrial Average, tremendous recovery today, currently up about 160 plus points, 16,312. Interesting thing, take a look at the low. The low today, 15,960. So we have seen this market move up about 300 points off of the low. We're trading dramatically lower this morning in triple digits, closing in triple digits. An incredible key reversal day within the market. Will it hold? That's what we need to determine, obviously. Now, we've got a couple of factors at play here. First factor is crude oil, and crude oil really turned around today, up 8% on the day, 32.28. That market has had just tremendous strength following incredible weakness. It traded to a low of 29.40, the high 32.45. Can oil begin to climb back up, or will we find it under pressure again? Other thing, a very, very interesting market scenario, tremendous break in the US dollar. Incredible break, down 1.7%, and that's a lot with the dollar. 97.19 on the dollar index. And take a look at this euro dollar on the bottom and our US dollar on the top in terms of this chart that we're looking at. When we do that, you can see this dynamic move that we made today in the dollar, breaking through different levels of support. I had a major level of support at the 23% retracement level. That comes in at around 99, 98, 90. You can see once it broke through there like a hot knife through butter, 97, 92, so call it 98, and absolutely through there. We do have a level of support that comes in right here at around 97. That's based upon these lows that we saw back in December, and the market did test this particular price point and came up ever so slightly. Same thing with the euro dollar. 109 is where we had pegged real support in the market, which was this. You can absolutely see how this market oscillated both above and below this particular price point with no clear distinction. But today that would all change because we dramatically saw this market move higher on the day. S&P's trading up about 1/3%, up about 7 points, 1904. But there's absolutely no doubt we have seen this market have some wild swings. We're looking at a very, very short-term half-hour bar chart, candlestick chart. Our day starts here, this of course being the 3rd. You can see that in overseas trading activity, it trades narrowly within a range, high roughly at around 1908, the low roughly call it 1996, 1995 in that area. Then we get this tremendous drop in the market, takes it from the 1900s down to 1846. Again, this is a half an hour candlestick chart. So in the course of a 1 hour period of time, we saw this market move from 1908 on the high, to 1872 on the low, traded within this confined area, topping out at about 1884, 1888, and then 2 hours, the same time it took to move the market down, 2 hours, we saw the market move back up, make new highs. So a tremendous kind of a V and a key reversal when we simply look at this chart. Again, only a half-hour chart, but we certainly get a reversal, this W that comes in here. Now, what does that mean in terms of the bigger picture within the market? And really what we want to do is to look at our daily S&P E-mini chart. Obviously, we got beat up the other day. It was a calculated loss. We took a 23-point loss. My sense is that once we have a clear determination and we get on the trade and the trade moves in the direction we anticipate, we not only have a chance to make that 20 points back, but I am looking for a 30 to a 50 point trade. Just imagine getting in the market even at 1938 and the market trades back to 2000, and that's the kind of move that I'm looking for in terms of accomplishing in the market. The one thing is we've tried to ascertain at what point this market would bottom and begin to move up, and it hasn't been an easy play. As we talked about a little bit yesterday, we have had this market not only show us this is a three-river evening star variation, we had a three-river morning star variation, we had the market genuinely tracked and trading sideways. And so we are, in my opinion, forming a base within the market, but that base is not an easy base to read nor to trade when we look at the kind of range that we see in the market. As we talked about just a few seconds ago on that 30-minute chart, we had a tremendous range on the day. You can see that in this candle right here. This is our daily candle. 1860 on the low. Of course, it didn't go quite that low. The low was 1865. So we had 65 to 1912. Considering that you've got 35, 45, 47 point range just within the given day, a 20 point stop is really a tight stop within this particular market. So traders, next I want to look at our daily chart, E-mini, same chart in terms of where we have our fib retracement, but this is a Heikin Ashi or Japanese average chart, and they're always going to lag behind because they're average based. But what they do is they take a lot of noise out of the market. Such a clear-cut and defined sell-off in the market, such a nice rally, although when you look at this rally has been meek at best. You see how small-bodied these candles are. You see that you have a lack of tails at the beginning of this sell-off, but then the tails come in right prior to the market turning around. Here you've just lost that tail, but now these tails are back again. So we're not getting a clear-cut signal within the Japanese average charts, at least not on a daily chart. And then lastly, what I want to look at is our weekly chart, because here's the key, and here's what I'm looking at. We have seen this market sell off before. We have seen this sell off actually go into a corrective territory on a number of occasions, this being one of them right here. And we are certainly having a 10% correction from the most recent and record highs up around here above 2100. You saw that here during our August meltdown. I believe that's what this is. This, of course, is a weekly chart. And then we saw it just recently under those same concerns. And the key is that on every occasion that we have seen this market sell off, we have seen at some point this market recoup. I mean, if we go back, of course, to 2008, when the real bear market hit, that's a different story. There we had a real bear market for a period of time. But for the better part of 2010, 11, 12, 13, 14, and 15, we have seen this market in essence trade above this 200-day moving average. So my sense is that once we have a clear determination that we've got the bottom and we're moving back up, our upper level targets once again have to be first the 50-day and then the 200-day moving average. So I think we could see some significant action within the market to the upside. We've just not been able to nail down a marketplace that's going to become one directional to the upside. I still think we're close to it. We certainly didn't hit it the other day. I apologize for that. But what I do believe is that the next couple of trades will more than compensate and greatly reward us for having the patience and the fortitude to trade this market. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow on Thursday.